Hi, I'm Brad Case, Homes.com's chief residential economist, with one thing you should know about the homes market. This week it's home prices and inflation. If you zoom way out and look at more than 100 years, most years are pretty similar. Home prices tend to rise at about the same as the rate of inflation. Sometimes home prices pull ahead, sometimes they lag behind, but a long period of dramatic difference, that's pretty rare. That helps put today's market in perspective. Over the last year, home prices have continued rising, but at less than the rate of inflation. For home prices, it's been about 2%, and for consumer prices, about 3%. That's very different from the pandemic years when home prices raced way ahead of everything else. That gap made it seem as though housing was getting more expensive every month, even if your income was increasing. But that gap is now closed, and recently it started to reverse. Here's why that matters. Affordability depends on how income growth, home prices, and inflation move together. If income is growing more rapidly than both inflation and home prices, then it becomes easier to buy a home. If income is growing more rapidly than inflation but less than house prices, well, people generally feel better off, but home buying is still tight. But if house prices are increasing more slowly than inflation, then at least housing isn't getting more expensive relative to everything else you buy. Whether affordability is improving depends on whether incomes are growing, but at least the pressure is easing. Even if mortgage rates don't fall right away, lower price growth helps the market ease into a more normal rhythm. For example, if you're trying to buy, at least it doesn't feel as though house prices are sprinting away ahead of you. That gives you more time, more leverage, and less pressure to rush. I hope that's helpful. For Homes.com, I'm Brad Case.